Hey guys, welcome to another video by Fully Informed Trade, or FI Trade for short. My name is Alex and I'm going to go ahead and review the markets, talk about the stock, the bond, the commodity, and the Forex markets. Without further ado, let's talk about the dollar index, which is the Forex. Dollar index continues its upwards trend and it's currently at around $80.88. We're getting close to the $81 mark, and the $81 mark is very important because that's where we have some short-term resistance. One thing that has me a little concerned is the strength of this rally. It's not a gradual pacing. It looks something like along the lines of this, except on bigger steroids. We have a lot of demand for the dollar right now, and people are just trying to revalue the dollar and try to push it a little higher. Every time I see the dollar rally, though, eventually stocks, commodities tend to pull back as well. However, if we want to look at it from more of a detailed perspective, earnings season is pretty much coming to a close, or for certain companies, and a lot of people are just trying to sell stocks before those companies ever report their earnings. But the most important earnings are pretty much going to start somewhere around, give or take, January 10th, 2011 and onwards. Pretty much it's going to start with Alcoa generally, and then it's going to move on to the major blue chip stocks after that. We got a lot of important names being reported, but my experience has shown that either the stock market pulls back a little before the major companies start reporting, or just right after. So that being said, how should we play this market? Well, we should try to go for something a little more conservative. And if you got any stocks in your portfolio, and if you're a short-term trader, and this isn't exactly for long-term investors, I'm just talking purely for people that are going for shorter term, I would avoid trying to hold on to stocks even after earnings. So if you have XYZ company and they're going to be reporting earnings in a couple days, this is the time you should start getting rid of your stocks before you get disappointed like the Family Dollar investors did. Family Dollar missed expectations and it went down by 10% in a single trading session. Likewise, you should avoid that by not holding on until earnings are going to be reported. And how you find that out, you could use AOLfinance.com. It has their upcoming earning release information, or you could just contact your broker. There are plenty of ways to do it, but it's all totally up to you. Let's go ahead and review the stock market. The stock market pretty much had a negative day. We could take this as a weakness in demand, but more importantly, over the longer term, I feel that the markets will be positive, and will end the year positive. So if you have like a 5 to 10 year investment horizon, these short-term moves shouldn't really bother you that much. You should just take them as an opportunity to dollar cost average in at better valuations. Wait for some pullbacks to just buy into more stocks at a cheaper price. Let's go ahead and review the 3-month chart just so you can get a better idea. We have somewhat of a negative day, and we're starting to lose a bit of some momentum, but we're still embedded on the slow stochastic right there. So overall, this trend is still strong, but only up until earnings, at least maybe until the give or take after 10th of January. That's when things start to become a little unsafe. And for value plays especially, it's not exactly the safest time to be in. If any of your value stocks are reporting earnings or something like that, you should definitely sell them, because value companies have a tendency to appreciate in a short period of time, but that doesn't mean they'll perform wonderfully in a short period of time as well. Let's go ahead and look and see. First of all, we're starting to see that the markets are starting to lose a bit of their momentum. Obviously, in this type of situation, you would either hedge your position, or if you're a short-term investor, even if you're a longer-term investor, you could, if you're willing to sacrifice some tax money, I guess you could call it, you could start selling some of your shares and start converting them into safer stocks, stuff like let's see, Campbell Soup. Campbell Soup has like a give or take 3.35% dividend yield. What makes it more attractive than that, though, is pretty much the fact that it has decent, I mean, it has really good dividend yield growth. I mean, give or take, it has a 10% yield growth over a period of 5 years. Compound that equals 26.5% dividend yield. So let's say at a 26.5% dividend yield, that's like you getting 25% back in a stock that you bought currently every single year. So give or take, after 2020, it would only take you 4 years just to make back whatever you invested initially, on top of the dividends that you already earned during the previous 10 years as well. So pretty much you can start looking for dividend plays. There's also companies like Pepsi, and these companies have a really low beta, and beta is pretty much how it just measures how volatile it is. And you know, even if in a major stock pullback, these are the type of companies that don't really get hurt that much. For instance, the Campbell Soup has like a give or take 0.26 beta, so it moves S&P. Let's say the S&P 500 fell by 10%, Campbell Soup would only fall by 2.6%. Same thing with Pepsi. I still feel that Pepsi's is a pretty good play. If go ahead and look at it, 2.87% dividend yield on top of around, I believe, historically, give or take a 15% dividend yield growth. So good story there as well, and the economy is definitely going to improve over the next 5 years. So Pepsi is another play that I like, and let's go ahead and look at Johnson & Johnson. Now Johnson & Johnson is another play that I think is interesting. It has like a 3.4% dividend yield currently, but it also has a lot of yield growth, and this is in the drug and yeah, just major drugs, healthcare. Healthcare is a growing industry. Last time I checked, more people are retiring than ever. We got the hugest growing population of baby boomers, and they're going to need a lot of these type of products that Johnson & Johnson does produce. Johnson & Johnson pretty much sits at around a 12% dividend yield growth. So over the period of like 10 years, I'm assuming you would have, give or take, a 28% dividend yield every single year from that point onwards as well, based on your initial investment amount on top of stock appreciation as well. So if you buy in at $63, maybe 10 years from now it'll be at like maybe $80 to $90 on top of getting a 25% dividend yield from where you initially bought it at as well. And if you reinvest those type of dividends over the longer term, you should be able to outperform the markets and handily beat major Dow component stocks just by reinvesting dividends and stuff like that. It's a safer way to play the market if you don't feel too comfortable with the current stocks that you're holding onto as well at this moment. Let's go ahead and review some key commodities. So let's start with give or take gold. Gold still a little bit weak, and that's mainly because the dollar index just continues its upwards rally. It's still strong, and for as long as the dollar index is strong, you shouldn't really be buying into any type of commodity at this point. I think that the golden year, or not really the golden years, but the great rally we've had for the last couple months is coming to a close now, especially across all things that include stocks, commodities, not necessarily bonds. Bonds will probably continue their longer-term downtrend, but they should still be hot if the markets start pulling back because investors will have a flee for safety. But still, I don't feel that comfortable with gold. It's crossed below its major trend line over here from a 7 to 8 year standpoint. That's not very good because that just implies that this market should continue going lower. 1,300 to around 1,200, somewhere in that area, would be considered a practical zone. Because that would be considered a give or take 10 to 20% correction. That's what I would anticipate out of the gold market. I don't see it revisiting July lows of around 1,160, but I do see it somewhere sitting around here, somewhere around here to right here, somewhere between around 1,300 to around 1,200 50 pretty much. That's pretty much the target zone. That's when value investors should start looking to get in back into the gold market, because this correction will have a major will be pretty major in degree, but there's still going to be some great opportunities in the gold market later on in 2011. Same thing with silver. Silver has overextended over the longer term, but if we're looking at a give or take 10 to 20% correction, let's go ahead and zoom in a bit and see where would a 10% to 20% correction would be. That'd be sitting around, give or take, a $6 to $7 loss. So that'd be somewhere around $25. So $25 would most likely be the target zone for the silver market for any value investor wanting to get back into it. $25. I don't really see it going back down all the way or anywhere below $22 or $23. I think that a great place to get back into it from a correction standpoint would be around $25, and then it will probably continue its longer term uptrend just because the overall economy is inflating. That's all I have time for right now. For part 1, I'm going to go ahead and review the markets in more detail in part 2. And like always, be sure to check out the charting software that I use. There's a link below or above this video.